Welcome all to FSA Learning Module 9, Analysis of Income Taxes. This is one of those readings that has a prerequisite reading, which covers a lot of the foundational material, a lot of the definitions you'll need, and allows us to just focus really on the analysis a little bit more here and some practice questions. So if you haven't had a look at that, and terms like deferred tax asset, deferred tax liability, temporary difference are unfamiliar to you, may help to go and check that out first. If you have, let's get into the module. There are 4 learning outcome statements. Let's hit the first one, which says contrast accounting profit, taxable income, taxes payable, and income tax expense, and temporary versus permanent differences between accounting profit and taxable income. So let's do just that with a review of terminology. First up, accounting profit, also known as pre-tax income. That's what we'll see in the income statement. It's reported in the income statement, and it is based on accounting standards. Taxable income, on the other hand, that is the income figure that the tax authorities will calculate and use to charge income taxes. Taxable income is your income subject to income taxes under relevant tax laws, and this is the key. We have a pre-tax income figure in our income statement, which is based on accounting standards, but taxable income, the figure on which tax payable will be based, which is prepared using tax laws. If the two are different, then accounting profit and taxable income are likely to be different. Those differences could be due to temporary differences, could be due to permanent, or both. More on that later. Income tax payable, that is on the balance sheet. It's what you owe. It is based on taxable income. It will be reduced by whatever income tax we actually pay, the cash tax paid. So not overly excited about these two. This is the key. This is what drives the world of deferred tax. A couple of definitions that help you calculate deferred tax. The carrying amount. The carrying amount is the amount at which an asset or liability is recorded in the financial statement. So that's your accounting side of it. As opposed to the tax base, which, as the name suggests, is what the tax authorities have calculated. That's the amount at which an asset or liability is valued for tax purposes. If they are different, the carrying value and the tax base, if there are differences between them, again, could be caused by a temporary difference, could be caused by a permanent difference. If it's caused by a temporary difference, that is a difference between accounting and tax law that will eventually reverse. Good way to remember it. It just results from timing differences. The classic example you've seen in the prerequisite reading is depreciation. The accounts are depreciating at one rate, the tax authorities at another. Eventually, the entire cost of the asset will be depreciated. They're just going through at different speeds. Now, what does that mean? It means the tax value, the tax base, is going to be different than the carrying amount. And this is what it leads to. Either a taxable temporary difference. A taxable temporary difference occurs where the carrying value of the asset is greater than the tax base. Just pause for a moment. Think of your prerequisite. How could that happen? Imagine we have an asset. You are depreciating straight line in the accounts, but with an accelerated method under tax law. Slower depreciation in the accounts, higher carrying value of the asset than the tax base. That is a taxable temporary difference for an asset. And if the carrying value of a liability is less than the tax base, that is a taxable temporary difference for a liability. Both of those situations will lead to a DTL, a deferred tax liability. Your temporary difference could also be a deductible temporary difference. The opposite situation, the carrying value of your asset is less than the tax base, or the carrying value of your liability is greater than the tax base. In those situations, you have a DTA, a deferred tax asset. Compare that to permanent differences. Permanent differences do not reverse. It is not a timing difference. That is just a difference in tax law and accounting standards that says this is allowable in the accounts, but not for tax purposes, or vice versa. Because it never reverses, It is never used to calculate a deferred tax balance. The word deferred simply means, oh, this is going to occur in the future. We're going to see this in the future. That's not the case with permanent differences, so there is no deferred tax. In that situation, if you have permanent differences, the company's tax rate, and we'll specify that later and start to calculate effective tax rates, will not be equal to its statutory tax rate. If the only differences you have are temporary, and you account for those using deferred tax balances, then your statutory tax rate will equal the tax rate you'll see in your accounts. But as I say, more on that later. So we have the terminology that's meant to be a review. You've seen this before, particularly how to calculate your deferred tax positions. So let's just finish off by looking at tax expense and a couple of questions just to make sure this is all in our head. As I say, because you've seen so much of this before, we can just use this more as a review, this little module. So tax expense, it is your provision for income taxes in the income statement. So you're going to see it just below pre-tax income. This is the key. What's it made up of? Income tax payable. Remember, that will come from your tax law. So that will be your taxable income multiplied by the statutory tax rate. Your tax authorities will say to you, this is what we've calculated as taxable income. This is our statutory rate. That's what you owe us, as we defined earlier, income tax payable. But to get to tax expense in the income statement, we will adjust income tax payable for our changes in deferred tax assets and liabilities. For example, if you had a deferred tax asset and it increased over the year, that increases assets, which is a good thing, a debit if you're into debits and credits, and will lead to a credit in the income statement. Good news on the balance sheet, good news in the income statement. If, on the other hand, you had a deferred tax liability that increased, that's an increase in liabilities, bad news, a credit, and leads to a debit in the income statement, i.e. a charge. And you could obviously reverse these arrows and reverse the answer. Those two together give you your tax expense. And if all we have are temporary differences, and all of those temporary differences are reflected by deferred tax assets or liabilities and their movements, then your income tax expense rate will be equal to the statutory rate. That's it for terminology. That's everything you should have seen before, just reviewed. Let's make sure we are happy with it. And if you're not, if these questions don't make sense, go back to the prerequisite reading. But if they do, we'll press on. So just 3 to look at. When accounting standards, so this is number 1. When accounting standards require recognition of an expense that is not permitted under tax laws, the result is a deferred tax liability, temporary difference, or permanent difference. Well, if it's not permitted, it is never hitting taxable income. If it's never hitting taxable income, it is a permanent difference. So I can rule out B, it is not temporary, it is permanent. If it was temporary, it would be a timing difference. It would eventually go through taxable income. A deferred tax liability. No, permanent differences do not give rise to deferred tax, liability, asset, or otherwise. So the answer is a permanent difference, C. Secondly, when certain expenditures result in tax credits that directly reduce taxes, the company will most likely record. It's a tax credit, it just wipes out a tax charge. It's nothing that we accounted for using accounting standards. So, that is never going to hit the accounts. If that's the case, once again, it is a permanent difference. If it is a permanent difference, there is no deferred tax. It's not an asset, not a liability, no deferred tax asset or liability. And finally, for the moment, early 2018, Sanborn Company must pay the tax authority €37,000 on the income it earned in 2017. This is just the matching concept. It earned the income in 2017. The €37,000 tax payable should be reflected on the balance sheet at the end of 2017. but obviously it won't be paid till the next year when it's finalized. This amount was most likely recorded on the company's 31st of December 2017 financial statements as taxes payable. Yep, that's very much the definition of taxes payable. Income tax expense, no. Remember, income tax expense on the income statement has a couple of elements, your income tax payable and changes in deferred tax balances. So not B. A deferred tax liability, no. Deferred tax liabilities are accounting constructs. They are different than the actual tax payable. So 3 is A. If they made sense, we are good to go. If not, as I say, do some prerequisite work. But if you are good, let's hit B. Explain how deferred tax liabilities and assets are created. I think we've already kind of mentioned that, but we'll go into a little bit more detail here and just clear up a couple of things in the reading in the module. And the factors that determine how a company's deferred tax liabilities and assets should be treated for the purposes of financial analysis. Yeah, again, we're going to have to clear up some things from the module here. I don't think you get much at all on the second part of that LOS here. So it's going to be a recurring theme. We will certainly hit it, but we're going to have to hit it kind of here and then kind of in the last LOS as well. So just be careful if you're going through the module and you think, I'm confused about deferred tax liabilities and assets now because it seems to contradict, and I don't see anything on financial analysis. I hear you. Bear with me. We will clear it up in here. First of all, then, deferred tax assets and liabilities. We've already said DTAs, DTLs result from temporary differences and are shown on the balance sheet. For assets, if you have a carrying value, so what is it on the balance sheet, that is greater than the tax base, how do the tax authorities have it valued? Then you'll have a DTL, a liability on the balance sheet. If the carrying value is less than the tax base, you'll have a DTA. For liabilities, the other way around. A higher carrying value is a DTA, a lower carrying value is a DTL. Now, just to give and make sure we're clear on this, to give you the absolute classic example, let's say in the accounts, in the income statement, we are charging 10% straight line depreciation. So let's say we have an asset with historic cost of 10,000 and we've charged 1,000. Carrying value is 9,000. Let's have a look at what the tax authorities are doing. Let's say they let you have, just to keep it simple, 20% straight line, tax allowable depreciation, same cost. 2,000 is your depreciation, 8,000 is your tax base. Now in that situation, very clearly, our carrying value is greater than the tax base. Our carrying value, it's an asset, and our carrying value is greater than the tax base. That will lead to a deferred tax liability. Now, if you've read something in the module that contradicts that, try and ignore it. They've just kind of scooched two examples together, which kind of overlap and make it look like this might lead to a DTA. It does not. That is a deferred tax liability. And the way I think about it is like this. Rather than having to calculate the tax base and even remember these rules, look at what a deferred tax liability means. Deferred simply means something in the future. Tax helpfully means tax. Liability is bad news. It's a payment. So a deferred tax liability just means we have a future tax payment. Why does that tie in to the example we've just done? Well, look what's happened. I charged only 1,000 of depreciation in the accounts, but the tax authorities gave me 2,000. I don't care when deciding what position I have on the balance sheet. I don't care about what happened this year. I care about the future. Having a higher tax allowance today, if this is simply a timing difference, a temporary difference, having higher tax depreciation today means I will get less tax depreciation in the future. If I get less tax depreciation in the future, that means I will get higher taxable income. And if I have higher taxable income, I'm going to have to make more payments in the future. That's why it's a DTL. So I always just like to think of it, what's the implications for the future? And that also makes it easy to calculate your DTA and your DTL. So on to the calculation on the balance sheet, what does it look like? If you can remember this formula, you've got most of what you need for DTAs and DTLs. Understand how they're created. We've just been through that. Again, there's more in the prerequisite. The calculation, it's your temporary difference. If we're on the balance sheet, that's going to be the cumulative temporary difference. So assuming this is year one of the asset's life, it's the difference between these two, 1,000, multiplied by the statutory tax rate. Let's say the tax rate is 30%. 1,000 times 30%, it would be 300. Why? Because we've had 1,000 of tax depreciation too much this year. We should have only had 1,000 to match. It's all about matching. To match revenues and expenses, you should have only given me 1,000. You gave me 2. It's too much. That reduced taxable income this year by 1,000, which saved me tax at 30%, 300. Great. In practical terms, that's good news. But we are concerned about the future because, once again, it is a timing difference, a temporary difference. I am going to have to pay that 300 in the future. Because I'm going to have to pay it in the future, it's a DTL. What does the income statement look like? Well, as we defined, we put our DTAs and DTLs on the balance sheet. The movement in the DTA and DTL over the year go to the income statement. We'll get a charge, as we said, or a credit. Almost the end of the story, just one little thing to add in, which is mentioned in this reading, in this little section rather, the valuation allowance. Deferred tax assets. I've defined and kind of walked through an example here of a DTL in quite a lot of detail. Let's do the same with a DTA. It's deferred. It's something happening in the future. Again, it's tax. But it's an asset, so it can't be a payment. It's actually future tax relief. It's not that we're going to pay more in the future. It's that we're going to pay less. A deferred tax asset results from the right to pay less tax in the future. That will occur when they've charged you too much today. Or the classic example, you have brought forward tax losses. Most tax authorities will allow you, if you make a loss during the year, you don't pay tax, but you can carry those losses forward to offset against future tax charges. If you can carry that loss forward and offset future profits, you will get future tax relief. How would you calculate the DTA? The temporary difference here is your losses. You'd multiply it by the tax rate. However, you have to be cautious. You should only recognize a DTA if you expect to be able to realize the economic benefit. Again, to continue with the classic example, as we said, the benefit of losses is that you carry forward and you offset against future profits. But hang on. If I've got brought forward tax losses, who's to say I'm ever going to have profits to offset them against? Now, hopefully you will. Obviously, some companies go through loss-making periods and rebound, but all the standard is saying is you've got to be careful. If you don't see any prospect of making enough profit to offset those losses, do not recognize the DTA. How do you account for it? Under IFRS, you would just write down the deferred tax asset. You don't need to write it down to zero. It's not binary. You might say, look, I think I'll probably be able to use about half of them. Okay. Write it down by 50%. You would charge the income statement. US GAAP achieves the same outcome, but just discloses it slightly differently. Rather than writing down the DTA, US GAAP will create a valuation allowance to offset it. As an analogy, just think net PPE. PPE, you show the historic cost, and you show accumulated depreciation against it to bring it to a net value. That's exactly how US GAAP works here. So let's run through an example of deferred tax assets and liabilities just to make sure we're happy with all those definitions. And as I say, just to clear up an example from the notes, which is kind of confusing because they scoosh two together and it kind of looks like they're doing the opposite. So let's make sure we're absolutely rock solid on how at least accelerated depreciation works here. So we're given a company with an asset, and it's in blue here, an asset that cost us $20,000 at the start of year one. We also have the income statement, and be careful, time is marching this way, years 1, 2, 3, and a calculation of taxable income. The statutory tax rate is 30%. Let's see if there's a difference in profit before tax and taxable income. There is. You can see in year one, profit before tax is 47. In year one for the taxable income figure, it's 3843. Where does that difference come from? Well, there's no difference in revenues, net gains there, inventories, raw materials, other expenses are all the same as is interest. The only disagreement accounting standards and taxable income has is on depreciation expense. In the financial statements, we're charging $2,000 depreciation a year. To calculate taxable income, we are deducting tax allowable depreciation of $2,857. Where does that come from? Well, an asset that cost $20,000 at the start of year one in the financial statements is being written off straight line over 10 years. But to calculate taxable income, the tax law says this asset should be written off straight line, depreciated over 7 years. That gives you a charge every year of $2,857. That is a timing difference. Why? Because in total over 7 years, taxable income will give you $20,000 of expenses. In total over 10 years, in the financial statements, we'll take expense of $20,000. The only difference is the speed at which it goes through, the timing. Because it's a temporary difference, we will account for it using deferred tax. Let's calculate. Year one. Carrying value at the end of year one. Remember, the carrying value is in the financial statement, so that's going to be on the balance sheet. Year one, $18,000. It cost us $20,000. We've charged $2,000 in depreciation. The tax base cost was $20,000. In getting to taxable income, we allowed depreciation expense of $2,857. That leaves a tax base of $17,413. At the end of year one, the carrying value is greater than the tax base. If the carrying value is greater than the tax base, we have a deferred tax liability. That's the rule for assets. To think of it another way, as I mentioned earlier, we have been given more tax expense this year than accounting. Tax depreciation expense was higher than accounting. We therefore paid less tax this year, but deferred, and the clue is in the name, deferred tax is all about what's happening in the future. What have we deferred? Well, by paying less tax this year, we have deferred a tax liability. Less tax this year means more in the future. So we have a DTL. How do we calculate? We take, because it's the balance sheet, we take the cumulative. Now this is year one, so 18 minus 7,413,857 is the cumulative difference. Because it's year one, it's just this year's depreciation in both calculations, 857. We take that difference and we multiply it by the statutory tax rate. Because they gave me 857 of extra depreciation, I saved tax at 30% on that, 257. That 257 I'll have to pay in the future. It's a deferred tax liability. The income statement takes the change in your deferred tax position. Well, at year zero, we had nothing. By the end of the year, we have a deferred tax liability. An increase in a liability will give you a deferred tax charge. So we charge $257 to the income statement. Year two. Carrying value in the balance sheet, we've now got 2 years of depreciation, so 20,000 less 4,000 will give you the 16. The tax base, 20,000 less 2 years of 2,857, 14,286. Cumulative temporary difference, 1,714. Multiply that 1,714 by 30%. Our DTL is now 514 on the balance sheet. I have a deferred tax liability of 514. That's the extra amount I'm going to have to pay in the future. What about the income statement? Well, the income statement takes the movement. Our deferred tax liability at the start of the year was 257. It is now 514. It has increased by 257. That increase is a deferred tax charge in the income statement. And year 3 is going to look very similar. Carrying value is now down to 14,000. Tax base 11,429. Temporary difference is now 2,571 at 30%. DTL is 771. That is an increase of 257. A charge in year 3 of 257 for deferred tax. If that makes sense, you are easily good enough on calculating deferred tax assets, deferred tax liabilities. Let's just see the impact of all that on the income statement. So here are the same calculations once again on the left with time marching that way, and on the right time marching that way. We've got our income statement and we've got our taxable income calc. Taxable income came down to 3,843, 14,423 and 25,843. Remember, I said the statutory tax rate here was 30%. So tax payable for each of those years, if you take let's start in year 1, 3,843 times 30% gives you tax payable of 1,153. In year 2, it'll be 4,327, and in year 3, 7,753. That is the end of the story for the tax authorities. That's what they want you to pay. What do our accounts look like? Well, we can't deny that we have these tax payable figures. So those tax payable figures make up part of our income tax expense. However, we adjust that for our deferred tax movements. From the previous page, we calculated each and every year a deferred tax charge of 257. So if you want to show these as expenses, you can. Payable is an expense. The movement in deferred tax, because it was an increase in a liability, was a charge, so they get added together. Year 1, our income tax expense line in the income statement will be 1,410. Year 2, 4,584. Year 3, 8,010. And one final interesting thing about that, if you're saying, oh, why are we bothering with this, Richie? Let's take a look, and we'll calculate this later on. But let's take a look. I say calculate later on. We'll define it later on. We're calculating it here, ironically. Your effective tax rate. Your effective tax rate is your income tax expense, not payable, your expense, so this figure, compared to your profit before tax. Let's do year 1. We just calculated our income tax expense as 1,410. Our profit before tax, 4,700. 1,410 over 4,700. You calculate that, you get an effective rate of 30%, which just so happens to be your statutory tax rate. In year 2, and you probably already guessed what's going to happen, we have tax expense of 4,584. We have profit before tax of 15,280. We have an effective tax rate of 30%. And in year 3, we have 8,010. We have profit before tax, 26,700. We have an effective tax rate of 30%. None of that is coincidence. When the only difference is, and we mentioned this earlier on, if the only differences between your taxable income and your profit before tax are temporary, we make adjustments for those. If we can spell adjust, we adjust for deferred tax, and we end up with an effective rate equal to the statutory rate. Will that always be the case? Yes, if your differences are only temporary. You get a difference in those two rates when you have permanent differences because we don't adjust for them. Once again, because this is kind of a reviewy module that builds on stuff, let's make sure we're happy with what's gone on with a couple of questions. First of all, analysts should treat deferred tax liabilities that are expected to reverse as... Now, if you're thinking of suddenly skipping back in this video to say, oh, where was that? It wasn't. We've not mentioned this at all in this module. As I was saying earlier on, it's all a little bit strange. We haven't mentioned that at all. But for me, this is what the LOS is getting at when it talks about financial analysis. How a company's deferred tax liabilities and assets should be treated for the purposes of financial analysis. That's the quote from the LOS. That's what this question for me is hitting. And we haven't talked about it. We will later again because it crops up again. Let's have a look. A DTL. Well, if we expect it to reverse, and that's the key phrase we haven't really mentioned, but we should. If we expect it to reverse, what does that mean? It means it will be paid. So remember my simple example from earlier. From year 1 through to year 10 for that asset, we were charging $2,000 in depreciation up to $20,000. When we were calculating, that was in the income statement. Getting to taxable income, it stopped at year 7. We had 2,857 every year up to year 7. This deferred tax liability would reverse in years 8, 9, and 10 because we get nothing as depreciation expense when we're calculating taxable income in years 8, 9, and 10. Which means taxable income in those years is going to be too high compared to what we think it should be using our accounting depreciation. So in 8, 9, and 10, we'll pay more tax. The DTL is reversing. When we said we had a future tax liability, that is where we're paying it. We say the DTL reversed. If that's the case, it is indeed a true liability. What should I do as an analyst? Well, I agree. It's a liability. Let's treat it as a liability. Now, that does beg the question, are the other two answers just absolute nonsense because this question seems phenomenally straightforward? Well, we'll look at the opposite situation. What if you have a DTL that is not expected to reverse? How can that be, you might say? Well, certainly if you just bought one asset and sat back for 10 years, it would reverse. But imagine, in year 7, you buy another asset. If in year 7 you buy another asset, you're going to kickstart another set of excess depreciation. And if you keep buying enough new assets, you keep getting tax depreciation that is greater than accounting, this DTL can actually just keep increasing. And that's not an unrealistic situation, is it? A company that's growing and buying more and more and more assets, getting more and more tax depreciation. You could well just see a DTL that continues to build. If that's the case, you're never going to have to pay it. So get rid of the liability and instead put it back in equity, whatever they've charged. Because remember, if you set up a DTL, you have to put a charge in the accounts, charge in the income statement, hits retained earnings, hits equity. So remove the liability and instead include it as equity. Is the third answer sensible? C, neither liabilities nor equity? Well, that's when you don't know. I couldn't commit to saying it's definitely going to reverse. I can't commit to saying it won't. I'm unsure. That's when you'd go for C. So not mentioned here, but no, it's in two key places. Key place number 1, it's part of the LOS. Key place number 2, it is a question at the end of that little section. Key place number 3, where it isn't, is actually in the module, but there you go. We've covered it. These are the key points. Is it expected to reverse or not? A couple more just to check we did understand what they actually wrote in there. When accounting standards require an asset to be expensed immediately, so kaboom, it's gone, but tax rules require the item to be capitalized and amortized, will record a deferred tax asset, deferred tax liability, no deferred tax asset or liability. Let's rule out C. It's not C because we clearly have a temporary difference. All of it goes through the income statement immediately. It will all go through the tax return as amortization. It's just a timing difference. So we need to adjust for deferred tax. Asset or liability. What have we done in the accounts? We expensed it immediately. So if this was our $20,000 asset, we put $20,000 through year 1 and nothing for the next 9 years. Tax authorities are capitalizing and amortizing, so stick with that. Maybe they just charge $2,857. We've got the opposite situation here. In this case, the carrying value is lower than the tax base. That leads to a deferred tax asset. By my other logic, or the other logic, I have charged $20,000 against my profits this year, but tax authorities only gave me $2,857. In the future, when I've got nothing left to deduct, tax authorities are going to be deducting $2,857 every year. In the future, I'm going to get more relief. I'm going to get a lower taxable income and have the right to pay less tax. Less tax in the future is a DTA. You should be able to see that was the opposite situation to the example we walked through. And worth just bringing this one in from the end of the reading as well, because sometimes trips people up. The tax base can be tricky. A company receives advance payments from customers, so we've got the cash, that are immediately taxable, but will not be recognized for accounting purposes until a company fulfills its obligation. So let's say it's $10,000. It's an advance payment. We have not fulfilled our obligation. That is deferred revenue. Because it's deferred revenue, it sits on the balance sheet as a liability, so there's its carrying value, but it's being taxed immediately. So I've paid the tax today. That means I'm going to be able to recognize this revenue in the future and not pay tax on it. If I can recognize that revenue in the future and not pay tax on it because I've already been hit, I paid too much tax today, that is a deferred tax asset. 3 is A. So typical questions you could get on DTLs and DTAs in here. This one, I think, is the financial analysis that was worth hitting because we didn't get too much background on it, or any, in the module. Next up, calculate, interpret, and contrast an issuer's effective tax rate, statutory tax rate, and cash tax rate. 3 definitions, let's hit them. First of all, statutory, probably the simplest. The corporate income tax rate in the country in which the company is domiciled. That is your tax rate. If you're in the UK tax rate is the statutory tax rate. As opposed to the effective and the cash tax rates, which are both just accounting ratios. To calculate your effective tax rate, take reported income tax expense, that's from the income statement, and remember, that is going to include both your income tax payable and your movements in deferred tax, and divide it by pre-tax income. The cash tax rate, as the name suggests, uses the tax actually paid. You could obviously find that from your cash flow statement. The tax paid in cash in the period over pre-tax income. Both useful. The effective tax rate, used by analysts in forecasts for net income, and your cash tax paid for forecasting cash flows. Makes sense. Now, we touched on this earlier on. There may be differences between your statutory and your effective rates, not due to deferred tax. Remember, deferred tax gets these in line. But if there are permanent differences, so tax credits or expenses not deductible for tax purposes, they are permanent differences, They do not lead to deferred tax. Therefore, they will cause a difference between the statutory and the effective rate. There may be adjustments to previous years. Maybe your tax calculation last year was too low or too high. That amount will be adjusted in this year's. Dividends may have a withholding tax. Or activity outside the country of domicile. We said your statutory tax rate came from the country where you are based. What if you have operations overseas? Well, let's take a look. Nice little example on how it shakes out. ABC, a hypothetical company, operates in countries A and B. The tax rate in country A is 40%, and the tax rate in country B is 10%. First year, the company generates an equal amount of profit before tax in each country, as shown in Exhibit 11. 100 from country A, 100 from B, 40% 10, 40 and 10, 60, 90. Equally weighted, you could see there, so it's pretty easy to work out that the effective tax rate is just an average of the 40 and the 10. But this is the interesting question. What will happen to the effective tax rate for the next 3 years if the profit before tax in country A is stable, but the profit before tax in country B grows 15% annually? Well, we'll see the whole answer in a minute, but just kind of logic it out to begin with. Country A, profit before tax is stable, so I'm just going to hop to year 3 to see the biggest difference. 100 for A, effective tax rate is 40%, hence tax is 40, net income is 60. Fairly straightforward stuff, nothing changed. B, we've got profit before tax growing 15% annually. So profit before tax by year 3, if we grow 100 by 15% for 3 years, that's going to be 152. At an effective tax rate of 10%, we're paying 15 with a bit of rounding. Net income is 137. We're asked for the effective tax rate. Well, in total, tax is now 55 on profit before tax of 252. 55 divided by 252, 21.8 or 22%. So you can see your effective tax rate is influenced by the countries you do business in, and if the weighting changes, the amount you sell in 2 countries changes, that's going to impact your effective tax rate. The analysis, I think, is fairly intuitive here. What happened to this company? What was it called? ABC. What happened was or rather its revenues in country A that had a 40% rate stayed stable, but its revenues in country B with a lower rate increased. We had a higher weighting in country B, a higher weighting in the country with the lower effective tax rate. That's going to bring your effective tax rate down. Was 25 is now 22. So just to clean this up and show you the whole picture for years 0, 1, 2, 3, you can see as our profits grew each year in country B, the country with the lower effective rate, our effective tax rate kept falling. A couple of extra points I've just jotted down as well. Let's not panic. If the effective tax rate is consistently lower than statutory tax rates or your competitors, that's not unusual. Tax avoidance does get a lot of press, but there is a lot of scope for tax planning before you get to tax avoidance. And effective tax planning can bring and should bring your effective tax rate down below your statutory rate. How far below and how much further below than your competitors depends on how good your tax planning is. So when you see that as an analyst, don't panic and think, oh no, I'm going to replace that with the statutory rate in my forecast because it's bound to mean revert. Not necessarily. Not necessarily. What you should adjust for as analysts is any big one-offs. So anything you don't see repeating, miss that out. And in fact, a common approach to trying to forecast is to take a normalized operating income. Base your tax rate off that normalized operating income, what's known as a normalized tax rate. It means take out special items, big one-offs, things you don't expect to repeat, and income and taxes associated with associates. Not something we see at level 1, but it is mentioned here. Associates are, if you're aware of it, just to give you the term, equity accounted for. Meaning if we have significant influence over another company, usually means owning somewhere between 20 and 50% of it, we'll actually bring in our share of their net income, which can distort our effective tax rate because we're being taxed on our income. We're not actually receiving this net income from this other company. It's just how we account for it. So bringing in that net income, particularly if it's volatile and a significant part of our total net income, can distort your calculations. So remove that, remove any one-offs, and get a normalized tax rate. The good news is we are pretty much done because the final LOS is analyze disclosures relating to deferred tax items and the effective tax rate reconciliation, and explain how information included in these disclosures affects a company's financial statements and financial ratios, an LOS on disclosures written in the way it should be. The first word being analyze. So you don't get sucked into sitting down and learning a list of 58 different disclosures. That's not what the exam should be about. It should be about, here's some disclosures, use them to practice everything you've just learned in the module. So use these disclosures to calculate effective rates, to calculate valuation allowances or interpret at least valuation allowances, and so on. So that's all we're going to do, and that's all the module does. It gives you the LOS and says, right, here's a big set of disclosures. Go have fun. So let's have fun. What the reading does is give you a set of disclosures for MU. If you look at the module, it will actually give you the balance sheets and the income statements as well, but we've just focused in on the interesting relevant stuff for the module here, the tax disclosures. On the left for 15 through to 17, what we have at the top is our income before tax. We're also excluding income or loss attributable to non-controlling interest. So if we have subsidiaries in a set of group accounts, non-controlling interest is the ownership in that company that we don't have. And equity in net income of equity method investees, that's the associates we mentioned. So we've excluded all of those. Not going to see that at level 1, just know they've been excluded. So we have 5252 USD in income from foreign sources, a loss of 56 in the US to give us 5196. What was our income tax provision? Down here, which is our expense for income tax that we're showing in the income statement. Well, it was made up of current taxes, 152 due to foreign operations, less 1 for state, no federal, so 153. That's our current taxes. We also had some deferred taxes, nothing in the US federal, nothing from state, 39 from overseas. So that 153 looks like tax payable. That 39 is a positive number. Looks like deferred tax credit, offsetting the 153 to give you an income tax expense of 114. Now, if I was to tell you this company had a statutory tax rate of 35%, you might look at that and say, well, that looks weird. If we hadn't just been through this module. Because you'd say, look, if I take my 5196 and I multiply it by 35%, surely my income tax expense should be 1819. And I accept, even if you've read this module, you might say, I accept there may be some deferred tax items bouncing around, but they were only temporary differences. We adjust for them. That makes sure we stay at the statutory tax rate. So why on earth is it not 18? Now, just to be consistent with this, put it in parentheses. Why on earth is it not 1819? Why is it only 114? Is a genuine question you should ask and an interesting question, which is why will provide a reconciliation. A reconciliation of the actual tax expense and, there it is, what our tax expense would have been at the statutory rate. This is your 5196 at 35%. And you can see, as you probably will be able to work out from here, well, look, there's a lot of overseas action going on. That's the vast majority of it. However, we also have a valuation allowance change. Remember, valuation allowances are against deferred tax assets if we don't think we can use them. It's 64. Unrecognized tax benefits, tax credits, and the always disturbing other category gets you to the 114. So when they say analyze the disclosures, all we've really done there is say, look, they exist, and be aware you would see this reconciliation from statutory down to my income tax expense, i.e. the effective. We also get a breakdown of deferred tax assets and deferred tax liabilities and what they relate to. All the way down to here. We get our net figures and at the bottom, our totals. Now, we're not going to read every single line. We'll get a little bit tedious, but let's look at a couple of questions just to bring it to life, to analyze it. First one up here asks us, MU discloses a valuation allowance of 2321 against gross deferred assets of 3782 in 2017. Does the existence of this valuation allowance have any implications concerning MU's future earnings prospects? Well, yes, possibly. Remember, we set up a valuation allowance against the DTA if we are unsure that we will realize its benefit in the future. A deferred tax asset is there because we have the right to pay less tax. We have to offset tax in the future to be able to realize that. If we don't have any future earnings, so if you had, this is extreme, but if you had no future earnings, you've got no future tax. Therefore, you've got nothing to offset against, and your DTA would be worthless. Now, to be fair, they haven't written off the entire asset. It's a valuation allowance against a substantial part of it, but not all of it. So that would give you concerns about their profitability. Now, if you looked at their income statements, you'd see they had returned to profit recently. And actually, if you go on, we don't here, but if you were to go on and look at the 2018 annual report for MU, you would actually see that they had reduced that valuation allowance almost entirely as they returned to profitability. But as it stands, if you have a valuation allowance, you have to say that's because they are concerned they won't have the profits to offset against. Second one, how would MU's deferred tax assets and liabilities be affected if the federal statutory tax rate was changed to 21%? Well, we did this earlier, but this is just to highlight that this breakdown of assets and liabilities allows you to answer this question. We can see we get all the way down to a net deferred tax assets figure of 749. Deferred tax liabilities of 17. So we have a net asset overall of 749. Remember, when you change your statutory tax rate, your deferred tax position is your temporary differences multiplied by the statutory rate. We saw from the previous disclosures, the statutory rate was 35%. If it's going down to 21, decrease in that, decrease in your deferred tax position. Because it's a net deferred tax asset, the DTA, the net DTA will fall. So both are falling, your liabilities are falling, your assets are falling. Because you've got more assets overall, it's going to reduce your deferred tax asset, meaning you would get a charge to the income statement. In addition, just to link it back to question 1, if you have a deferred tax asset, it's because you can offset against future tax charges. If you're dropping the tax rate substantially, and that is a substantial drop, then that gives you a lot less tax to offset in the future. You may have to write your assets down even further. And finally, one extra question that pops in at the end of this little LOS disclosure reading says quite simply this: Under what circumstances should the analyst consider MU's deferred tax liability as debt or as equity? Under what circumstances should the analyst exclude MU's deferred tax liability from both debt and equity when calculating the debt to equity ratio? Once again, a little bit odd. I don't really see that that's got anything to do with the disclosures they gave. There was no mention of it. This is yet again a throwback, I think, to that LOS that asks us how we should treat deferred tax assets, deferred tax liabilities in our financial analysis. So I'll just recap once more because it's come up at the end here. You have to think, therefore, it's examinable. If you expect liabilities to reverse, then include them as a liability. If you think the liabilities will not reverse, then remove that liability and include them as equity. If you don't know, ignore. So under what circumstances should they exclude the deferred tax liability from both debt and equity when calculating the debt to equity? When you are uncertain. When you're uncertain of the timing and the probability of those future cash flows. So it's a little bit odd, as I say, how the module is set up, the way they just sneak that question in at the end. I think it's part of the previous LOS, but it is just worth rather being aware of.